enjoyed watching this video and would love to stay up to date when I have more content like this or something similar that you may be interested in, please like and subscribe to this channel and click the bell so you get notifications. And I hope you have a great day. Thank you everyone for joining us today for what I've called the down payment discussion. And so, of course, today we're going to focus on down payment, what that means and what that entails for people who maybe bought several homes and or bought a home. You can learn something today. And also we'll focus on down payment assistance as well. And so to help me with this discussion, I've got Billy Slobin with the Slobin Group and the Mortgage Link. He is a branch mortgage manager. He started the mortgage industry in 1985. He has closed over $3 billion in mortgages and has been nationally ranked in the top 200 of loan originators. He has a team that helps him provide the quality of service borrowers deserve on every transaction. So thank you, Billy, for being here. We all greatly appreciate it.
Thanks for having me.
Yeah. So first basic question, people who don't know, what is the down payment for a mortgage?
Okay, so that's a very good question, Patrice. Most mortgages do require some measure of a down payment, with the exception of a USDA or a VA loan, which are zero down, but that doesn't mean zero money needed. And we can touch back on that when time permits. So once upon a time, in the olden days, a 20% down payment was really the standard and what people had to come up with one way or the other in order to put that down to facilitate a mortgage to buy a home. So I don't have the history books in front of me, but sometime probably in the 70s into the early 80s, the term PMI, or private mortgage insurance, came about, which allowed people to put less than 20% down to enable more people to be involved in home buying. And the reason for that, the difference was the bank, the lender, didn't want to take the risk of over 80% of the home's value, because if something went wrong and the home had to be resold once real estate fees and holding costs and all came into play, they would wind up upside down and lose money. So the concept of mortgage insurance, which is basically an insurance company that provides PMI, private mortgage insurance, that is paid monthly as part of a mortgage payment, enabled down payments over the years to shrink from 20%, 15%, 10%, 5%, and even now you can put 3% down if your credit allows for it. This is on a conventional loan. If your credit allows for it, and if you're a first-time buyer. If you're not a first-time buyer, you're going to have to put 5% down, again, if your credit allows for it. And on FHA loans, which I guess we could talk about different loan types another day, but on FHA loans, and I'm sure many have heard the terms, and if they want a deeper education, they can reach out to me directly. Patrice will give you the info, and I'll go through the whole gamut with you. But FHA loans require 3.5% down and are also insured not by PMI, but by MIP, Mortgage Insurance Premium. It's the government's way of insuring their position on a low down payment loan. Now, it should be noted that sometimes people have a lot of money or sell a house and have a lot of money and put 25% down, 30% down, 40% down. We did a loan for a couple very recently, a $450,000 house, and they got a $60,000 mortgage. So they had a very big mortgage, very big down payment from being third or fourth time buyers, building up equity, which building up equity is a huge part of what this discussion all will aim towards. Homeownership is a great way to build wealth, not instant wealth, but long-term wealth.
Yeah, if you do it the right way, right?
If you do it the right way.
Okay, yeah, thanks for the thorough explanation. So how does that differ from closing costs? I think
Okay,
people
so
put
when you're buying
together.
a house, yep, that's a great question, Patrice. When you're buying a house, there's excuse me, down payment, which is what we just talked about. The down payment's the down payment. The closing costs, second category, let's just say DP, down payment. Excuse me, when I'm talking to a client on the phone and walking them through this process, I tell them to get out a piece of paper the good old fashioned way and write DP, down payment, which could be 0, 3%, 5%, whatever the situation is. Next category, CC, closing costs. Closing costs are the next category, and they are an appraisal, credit report, title company, closing fee, title insurance, recording fees for the municipality, the lender fees, and they're their own separate category. In the good old days, they were $1,000. Now they can be $3,000 to $5,000, depending upon the size of the loan and the scenario. So that's the second category. The third category, which is also considered a closing cost, is PP, prepaid items, prepaid property taxes, homeowners insurance. That's a third separate category. Prepaid. You need money to put in a tax escrow account to pay bills that are future for the house you're going to own. You need money to pay. That's called escrow. You need proration money where you're paying back a seller for he has paid taxes forward for the house you're about to take over. That whatever your annual figure of that is divided by 12 and becomes a component of your mortgage payment. The third box, let's call it, is homeowners insurance. When you buy a house and you have a mortgage, you have to carry homeowners insurance on it. That could cost $1,000. That can cost $4,000. Depends on where, depends on how much. That figure is treated very similar. 1/12 of it becomes a part of your monthly mortgage payment. You do pay one full year upon closing, which covers June 1st, 2025 through May 31st, 2026. That annual figure that your insurance company charges you is divided by 12. Also, a third component of your mortgage payment. And why do I pay it up front and pay it monthly? Because the upfront covered the first year. The monthly builds up 1/12 at a time towards year 2. There's a fourth item at closing, interest adjustment. Interest adjustment is basically your prorated first mortgage payment of interest only. Because if you close down a loan today to buy a house, there's 2 days left in the month. You're going to pay 2 days of interest. You're not going to make a payment June 1st. On July 1st, you'll make a payment of both principal and interest. And the days of June upcoming are covered in that mortgage payment because interest payments are always made in arrears. So that's how down payments and closing costs differ.
Thank you. And I know you talked about percentage down. Um, are you finding that most people are still looking to stay around, well, conventional or FHA, right? Are you expecting that most people are putting between 3 and 5% down, or will just
Yes,
most people are putting
way
down?
more frequent. Your only people putting more down seem to be, and there's nothing's everybody, but mostly, unless somebody's selling a house and then buying a house, they're putting whatever the minimum down they can get away with, depending upon their credit score and their scenario.
Right, because they may have to put more down, depending
They
on.
may have to put more down to make it work, to make them qualify or to make them credit qualify.
Okay. And I think you kind of talked about the advantage of putting more down, but I think some people may not really grasp it because if you put,
Well,
or maybe you didn't, yeah, but if you put, what's the benefits of putting more down than the minimum?
well, every single scenario is going to be different, but the more money you put down, the lower your payment is. The more money you put down once you cross the threshold of 20% eliminates the need for mortgage insurance. Now, mortgage insurance is not a bad thing, but however much money you have is however much money you have. So, in so many situations, the mortgage insurance cannot be avoided. Um, the more money you put down, the larger down payment doesn't make the house appreciate any more than if you only had a small amount down. But there's an old phrase that people used probably before my time, and it's called skin in the game. When you put a bunch of your money into a house, you're way less likely to give in to any problems because you've got a lot of your money and your hard work tied up in the house. And so instances of default and or foreclosure are dramatically lower when people put a significant down payment down. When the economic meltdown of the late 2000s took place, the bulk of the loans that went bad in the homes that got foreclosed were people who had very little skin in the game for whatever reason, strategically or necessitated, either way.
Right, because if the value goes down and you owe more than the value and you need to
You're
sell.
quicker to give up instead of fighting back.
Okay. So caveat to that, right? You have advantages of putting down, and then sometimes you just need the house, so you put less down, right? So
That's right.
thinking about advisement for maybe you have a lot of money to put down, you know, comparing that to, okay, well, I also want to make sure I have money to maintain the house and in the
Upgrade
event
the
tax
house.
insurance go up, I want to make
Yep.
sure that I have money for that. So what would you say the best advice would be to consider down payment plus maintaining the house and other things?
So sometimes people want to put a small amount down because they only have a small amount. Sometimes people want to put a small amount down because they know the house is going to need things. And when you move into a house, there's more to consider than just the payment. There's the broken furnace, there's the worn out carpet, blinds, whatever else. And then there's a third category of how to look at it is I have some clients who want to put a small amount down because they want to keep their money in the market, making money. So it depends on how the person's financial life is and how they look at things. And then there's some people, which is a very large segment, is people who just don't have any money. And the very low down payment and or assistance is not a choice. It's the only choice.
Yeah, just to get the house. Let's just get the house and
Just
figure it out
get it.
later.
And we hope they figure it out because we're in the business of doing loans that are successful because not we don't want to do loans that default. Eventually that gives the lender a bad credit report or excuse me, uh, what do the kids get at school?
Reputation. Yeah, a report card.
There it is. Report.
Yeah.
It's been a minute. Yeah,
You're
we
just
don't want
doing
a
so
bad
many
report card
loans,
here.
you're thinking about
Yeah,
credit
we don't want a
reports.
bad report card. Yes, you want loans that perform.
Um, okay, and so yeah, you kind of you ease into down payment assistance. So for people who don't know, what is down payment assistance and how does the average buyer obtain it?
Okay, so down payment assistance is something where some organization, whether it could be the state, whether it could be another some sort of maybe nonprofit organization, which I think National Faith is a nonprofit, assist people with the upfront funds needed to buy a house, which is the biggest one of the two biggest challenges to home ownership, credit and upfront money. As long as they meet the criteria that is mandated, and there's no way for me to run through the criteria that's mandated for all the down payment assistance, but let's start with the one that is by 10 million miles most popular and most utilized. Here in Michigan, and I know there's people listening from other states, and we have down payment assistance that can be utilized in other states. That's another conversation or a phone call. But in Michigan, there's a agency called the Michigan State Housing Development Authority. It's an extremely well-run outfit that provides assistance to people to overcome the hurdle of upfront money to buy a home, to buy a first home. First-time home buyer is a main category of boxes that needs to get checked if you're going to utilize this type of down payment assistance. But it should be noted that there are areas, Detroit, Southfield, Pontiac, Royal Oak Township, not Royal Oak, Royal Oak Township, and some other, which are different places, and some other cities in Wayne County that are considered targeted by the state, which waives the first-time home buyer requirement. That's a big thing.
Yeah.
So, but otherwise, 90% of the state requires a first-time home buyer, which means you haven't owned a home in the last 3 years, or you don't own one now. You regain your first-time home buyer status after not owning for 3 years. So MSHDA provides a $10,000 interest-free, no payment, silent second mortgage. It's not a grant. People, it's not a grant. It's not free money. There is no such thing as free money. The $10,000 covers a large portion of the down payment, the closing costs, the prepaids. You have a minimum middle credit score of 640. There used to be asset restrictions that the people could have. That's gone now. It is income restricted, basically around $100,000, but each area, each county has different limits. It could be from 101 to 140. That's something we figure out for you. And it's based on the where, and it's based on how many members in your household. It also should be noted that that income for the household is also governed by any adult over the age of 18 earning wages in the house. Their income has to count toward that tally, and there's no way to hide people. The government has ways of seeing things that lenders may not, but the government does. They're the ones giving out the money. The money goes back to the state of Michigan when the house is sold or when the house is refinanced. We've seen it both ways. We've had clients who used this program 8 years ago who refinanced and paid off the $10,000 because their equity position had risen so greatly. So if you look at it this way, they gave you the $10,000. They didn't have you pay interest on it. They didn't have you make payments on it, but it enabled you to put $2,000, $4,000 in, $5,000, and enjoy all that equity buildup. And that money is your money because the state facilitated your getting into the home. That is, they also have, there's other versions of their program. There's ones without down payment assistance and a reduced interest rate. There's conventional and FHA versions. To do this program, you need a 640 middle credit score. Middle. To do the FHA version, you need probably 700 or greater to do the conventional version. And the 700, it's not cut and dry because the file has to go through automated underwriting and the computer has to like your file. So there's got to be enough positive aspects to your file to make that program work. Other down payment assistance programs, there's National Faith, which has money at different times for different areas. They had a $25,000 in the City of Detroit program last summer. Those are income restricted, even much tighter than MSHDA. Their credit criteria is a little looser, but each area runs out of money. Like right now, there's some Wayne County money and it goes by city, not by the whole county. So there's some money to be had. Those loans are different from MSHDA in that the assistance can be forgivable if the people live in the house for a certain amount of time, if their payment history is favorable, and I believe it varies between 3 and 5 years on the different flavors of the program. So these are all case by case things. Very good program, but it should be noted that where I mentioned that MSHDA is a very well run outfit, and you can close loans 30 days. If you have a sharp client who provides documents promptly, you close them not much any different than any other mortgage, providing your own down payment. I've closed some MSHDAs faster than ones where the people are providing. I've closed MSHDAs where the client is really sharp and MSHDA's fast, and boom, boom, they're here and gone. There's also ones where the people provide their own down payment, and it's slower because they're not as fast with paperwork. So that's how it goes. The National Faith, though, is a whole different story.
Yeah.
They are not fast like MSHDA. We've closed quite a few of them, but you're on their clock, and when we could get a file in and out of my shop here in 10 days, 2 weeks with the appraisal and whatnot, send it to National Faith, and it could take a minute for them to review it. Someone's not answering the phone aggressively like they do over it. It's a totally different ballpark. So it's important for people to know that different programs have different time frames. There's really another category, but it's kind of market driven. There's Essex programs, there's Chenoa programs, and what these are zero down FHA products. But really, the down payment is covered. The 3.5% comes in the form of a second mortgage. Depending upon credit score and scenario, some of them are forgivable, some of them are not. But you have 2 payments. The interest rates on these now, I've seen times in the past where the interest rates are great. But right now, these interest rates on these type of programs where they're providing a first mortgage for 96.5% and a second mortgage that covers the down payment for 3.5%, both the first and second mortgage have rates that are 2, sometimes 3% higher than MSHDA. And even though you're escaping the down payment for now, people don't want to pay the higher interest rates because it's big payments. So you'll find somebody here and there who it works really well for because there's a high earner who wants all their money kept in the market, and they don't think 8% is anything because they're making 13 over there. So they don't care. This one, pardon my blunt language, this one is not for broke people. This one is for strategic people who, I did one of these not that long ago for a guy who had $1 million portfolio. He didn't care at all about the interest rate. Was immaterial to him. He goes, show me how to bring the least amount of money to closing on this $480,000 house. Okay, this is how. I said, well, here's your worksheet for the first mortgage. Here's your worksheet for the second mortgage. The first mortgage is 7.5. The second one, which is obviously small, 3.5%, size of the price, was 8.5 or something. He goes, well, I'm making 12 everywhere, so I don't care. Of course, unless you're getting a seller concession, which I guess these days we see them more often than we did previous since 2017, you still have to come up with closing costs, taxes, insurance, like we talked about on question number 2.
You have to have
I hope
some
that
number.
helps. I know it's lengthy, but there's a lot to it. When people say, I need to talk about down payment and some, I'm like, well, it's not a quickie because
Yeah,
there's a
I
lot
mean,
to it. But
you answered some of my questions already, so you might be able to skip some of
skip
them.
some others. Well, that's
Yeah.
okay.
Well, but the next one is a good one, right? So prime timing here, MSHDA has increased their purchase price for borrowers to 544,000, 233,000. It used to
Okay,
be
so
two
here's how
hundred
it
and
benefits people.
twenty-four five, right? Or something, 224.
Yep.
Yeah. So, you know,
Well, previously the limit was 224,500 sales price for years, years and years. There's some areas that people really want to live in that don't have houses that are 224 or 500. The first two that come to mind, Southfield, Royal Oak, Livonia. Houses are over 224 in those places. Most of the houses are over that number. So this opens up a lot of areas for people who want to buy these more expensive houses. Some of these people have saved up $10,000, $15,000. But when you get up into that higher price range, you need $20,000 to close on a house. Even if you're putting 3% down, 3% of a $300,000 house, that's $9,000 right off the bat. Then you got taxes, insurance, closing costs, and you're $18,000. So the increase in sales price really helps a lot of people who we've had to for years tell people, well, sorry, we don't go up that high, or this program doesn't go up that high. Now, the crazy thing is the income limits were not raised very much. So, and let's just say it's again between 100, 120, 30 in some areas. So, yeah, you can buy, you'd have to sit down with a calculator, plug it in, but a person would have to have not one penny of debt, make the absolute maximum is allowed on the income limit to get within 1,000,000 miles of the 544. But the reason where the 544 came from some government median number.
mm,
I am friends with and work extensively with people at MSHDA. I even may go as far as to brag and say I get referrals from them for relatives and people not using MSHDA. The sweet spot for the increase in sales price is probably around 350. I now look at it as something that this brought Southfield back into play. Southfield does not have a ton of nice houses for 224, but they have a ton of nice houses for 350. Southfield also doesn't have a first time buyer requirement. It's a targeted area. So I tell all the agents I work with who hustle, go sell some houses and list some houses in Southfield because now we can give the people 10. Some people may have 15,000 they can devote towards buying a house. 15,000 is not getting you a 350 house, but 25,000 is. So there's great mathematical things that can happen utilizing the program. It's not just to shoehorn people who don't have any money into a house. It's to help people who have a household income of $115,000, very significant. They have money saved in their 401ks. They don't want to take money out of their 401k. They only want to use savings money. They may be netting proceeds of X out of their first house. This could be their move up house. This program has opened up Southfield tremendously because the no first time buyer requirement as well. Like I said, more expensive communities like Livonia, Royal Oak. Royal Oak's going to be tough. I don't know if there's anything in Royal Oak for $400,000 or $500,000, but maybe Berkeley, maybe Ferndale, maybe here, maybe there, but it's expanded some things.
yeah, and do you think, for some people that, okay, certain income they couldn't utilize, right? But they have the money, right? Does that kind of help them in some ways um, be able to qualify for more or no?
Say that again, please.
So, for example, let's say, well, I mean, because you can have different kinds of loans, right? But let's say you have someone that they have a base salary, but they get commission, or maybe they have money in the stock market and they just can't normally use that income to qualify to buy a house at a certain price range. Um, does this in some way help those people? Because let's say, okay, maybe I can do 544 because now I'm getting this assistance for even though my income is so fluctuates a lot or no.
Well, I don't think that doesn't really impact it
Okay.
because no matter what, your income, whether you're a self-employed person who has fluctuations where we use an average or a salary person, you still, the income has got to be completely documented. We have to use the same formulas that we always use. And I mean, to get up to the 544, you're going to have almost in every case more income than is allowed per their chart limits. So it's not going to happen too often. The only thing that this program is going to help with is the upfront money. Period.
And so for the was it first generation? Are
Yeah,
you
that's
seeing a lot of those go through? Because I think my understanding is that you would
so
need
many of them
to
went
have
through, Patrice, that it's zero. We did a whole here at my team. We did a ton of them. We knew from day one who to look at, what to look for. We did a ton of them. We got an email this morning. Let me read it to you. Yesterday there was 500,000 left. At 9:40 this morning, MSHDA 25K is out of funds, so it's zero. But we used the heck out of it for every single person we could. It was an $8 million issue initially at $25,000 a piece. So like 320 homeowners were made out of the initial blast. Then they added 4 million more to it. So that made like another 160 homeowners. And it ended yesterday, overnight. And like we sent one in and they sent it back with a 10,000 registration. So it just defaults to the perpetual program, the 25,000 first generation program, which let's kind of tell people what that was.
yeah.
But if you are a first time buyer or haven't owned in 3 years, if your parents hadn't owned in 3 years or were estranged or were deceased or had sold their houses more than 3 years ago, you were considered a first generation buyer, which made your down payment assistance 25,000 instead of 10,000, though it's the exact same rules as the 10,000 with the payback and owing it again. But what that program did was, it doesn't take 25,000 to close on most houses. So the let's just say it took 15. The other 10 we would use to lower the principal balance of the loan, which would make the payment lower. There was no other way to utilize it. You can't have the money for blinds or landscape. Didn't work that way. Had to go toward the loan. So the 25,000 made some people qualify that didn't qualify before. It made some people have enough money to close on a house a little more expensive than they were initially looking at, because MSHDA does have a mandated 1% minimum investment. Whatever the house price is, you have to have at least 1% into it. So $1,000 earnest money, a $500 appraisal or $600 appraisal goes towards your 1%. Now, because property taxes and house prices vary tremendously, sometimes you need 3,000, 4,000, 5,000, 6,000 because the 1% is a minimum. It's not a max. So you take your down payment, closing costs, taxes, insurance, total minus 10,000 equals 3,500. Well, that's a 170 house. So it's more than the 1% minimum. So the 25K first gen program let people never come up with more than the 1%. But there's only so many people who fit that criteria. The credit criteria was the same, the income criteria was the same, and it's a finite issue. 8 million plus $12 million. I asked my friend at the state, "Are you getting more?" He said, "No word on that right now." The 10,000, and this is to reassure and comfort people, is always there. It's a bond issue that the state has, and it's perpetual. It will not run out. So
Yeah, and that's a good in between, right? Because at one point it was 7,500, and there was a
yep,
short period of the 15.
the
So
15 was like a limited issue fund also. So the 7,500, like you say, that was the 10K of its day. But as house prices got higher, taxes got higher,
you need
people
more.
still needed too much money. So they raised it to 10. The 25,000 step, 15,000 step forward program that was around a few years back was really, really useful. But it was also, much like this 25,000 one, a finite issue. So we've been asking for that one to come back ever since. So
Yeah, and I've heard stories about certain lenders where they would push it off. They would take it, yeah, we do them, and then push them off to another lender
let's
and hope that the money was still there by the time they were done.
well, with all these programs, really, no company does very well by doing the state programs for themselves because the government mandates how much mortgage companies, mortgage loan officers can make. When they're doing these bond loans, you make less. The loan officer makes less, the company makes less. So you can't make your living only doing these, but you hope to be helping people, building relationships, helping realtor partners facilitate closings. And if you find a loan officer who's good at these bond loans and does them enthusiastically, that's the one to hang on to because they're selfless.
They really love
They're
it.
helping people. They could focus easily on not doing these and make more money, but making money is not as good as making friends.
And a lot of times you start there, you'll have more money.
You'll have more money anyway. You know, don't worry about the money. Worry about the people. The people got the money, whether they're rich ones or poor ones. You could do a loan for somebody, a small loan, somebody who doesn't make a lot of money, somebody who doesn't make a ton of money, but then they have 50 relatives or 50 coworkers who wind up with you. So you have to look at things in a bigger picture. Plus, you have to have it in your heart to help people. People need
Yeah.
help. Not all people, but people need help. And if they're nice and if they try to help themselves, they deserve help.
Good way to put it. So we'll skip down to some of those. Um, yeah, I do want to touch on some of the drawbacks, right? Because if they don't need the down payment, then maybe I mean, the assistance, you need down payment. But they don't need the assistance. It'd be something that they should consider in the long run if it makes more sense, right? Because it's not
Well,
a perfect scenario.
there's kind of two things. When you use it, you hamper yourself from taking advantage of refi markets. So you do, and it should be noted that the MSHDA rates are better than regular rates. But so right now you're getting 6 5/8 if you're taking the assistance, or 6% if you don't, which is well below market. We always take a look when somebody has their own money and not doing the down payment assistance, but at taking advantage of MSHDA's no DPA program, which is a real good deal. But what happens when rates go to 4, which they will? If you have a second mortgage that you can't get rid of, then you can't refinance. So there's a drawback. But you couldn't get the house otherwise. So if you for this is only for people using it strategically. If you're using it because you don't have the additional funds, then that's how it goes. But if you take it when you didn't need it, and then you're in a position where, geez, I'd sure like to have 4.5, not 6 5/8. So there's that. I guess the other drawback is you do owe the money back, but that it's not really a drawback because your uncle gave you 10 grand to buy a house. You didn't pay anything when you sold the house. You gave him his 10 back. You never knew it took place. So that's really about the only drawback. No ability to refinance unless your equity has tremendously increased. But that takes time.
Yeah, and if you like you said, if you need it, you need it. So what's more
And
important?
if you don't need it, you probably have the money to pay the second off independently on your own anyway.
Oh, that's a good question. I think somebody asked me that. So you could just go ahead and pay it off
So yeah,
or
let's just say a
refi.
guy did it because he had a bunch of money in the market and he put the 10 grand on there. I've had a guy do it before. Um, you could just pay it off. They'll take the money anytime, and then you can refinance like regular.
That's good to know. Yeah, I asked my ex that and I wasn't sure. Because yeah, I've had one of my very first buyers, they needed the money, of course, but he tried to refi a couple times. The value was never there. But
Right.
the good thing is, so let's say he bought it 2017
Well, then
and
the house
literally
by
sold
now is
the
worth
house.
enough to fold it in.
Right, because I literally sold the house in 2022, right after his anniversary of buying the house, the month, timeline. And we pretty much sold it for double than what he bought it for. So
See, that's easy
that
to
was a
pay it
good
off
deal.
then.
It was a good deal. Um, oh yeah. And I think we maybe talk a little about it, but of course, in my perspective, which you can correct me if I'm wrong, is, the more money that you're given, a lot of times the more documentation and length of time it can take for the down payment assistance to
Well,
come in.
these MSHDA programs take the exact amount of time, whether it's 10 or 25 or whatever.
Okay.
And the documentation is no different than if somebody's putting their own 3 or 5 or whatever down. But here's the thing: the people who got the 25,000, for instance, are the people, and we're renaming number 11 how to be pre-approved efficiently, because that's really what it all is.
Right, right, yeah. Because I mean, the thing
So
is, it a lot of times it depends on the buyer.
so get us the papers. Let's put it that way. When we tell you, please fill out the application, and you do halfway, quarter of the way, and let it sit, or you fill it out all the way and you take 2 months, 3 months, 4 months, a year to provide 30 days of pay stubs, 2 W-2s, a bank statement, and a driver's license. Guess what? All the other money got used up. I think that in the schoolyard, they say you snooze, you lose. So this is pertinent to this program because the people who were proactive is who got it. Period. In the mortgage world, our number one challenge is getting paperwork from people. So my advice to everybody is answer the phone when I call, read the text and email that I send you, take your 1 month of pay stubs, your 2023 and 2024 W-2, your bank statement, all the pages, please, even the blank one that's number 6, your driver's license, and take them to Patrice's office or your other agent for your buyer consult. And while you're buyer consulting, scan and send it off to me. You could have your pre-approval letter by the time you leave her office. Stop procrastinating, being incomplete, and doing a poor job on documents because, sorry, it's not adulting. You want to buy a house? You have to be an adult and provide the correct documents, not photos upside down and backwards. I've seen people come to me whose credit report has 5, 6, 700,000 of student loans. And when I say, but I don't have your paperwork, well, I can just take pictures of them, right? I said, no, you have to like scan or PDF and get them to us in a proper format. They said, how do you do that? I'm like, so $600,000 at college and you don't know how to do that? Come on,
Well,
get
that's
your paperwork together, do a good job, work with your agent, our agent, and myself. Get us everything, and you'll be out looking at houses before you know it. That's
yeah.
that is all of that.
Yeah, I tell people in my consultation specifically, I mean, everybody hates the mortgage part of the process, but it has to be done. If you look at it as you're asking for a large amount of money, you
And you're
know,
putting a very small amount in.
yeah, you're gonna if you ask somebody ask you for $250,000, you'd want to know a lot about them as well. And the
That's
sooner
right.
you get it to them, the sooner you can close. If you don't get it to them, you won't close on time. Don't think that something's gonna happen where you're gonna close and you haven't sent anything. So
Think about it. Can I borrow $100? People are going to be like, "What? $100?" Okay, so look at it this way: we're in a partnership. I'm putting in 97% of the money needed. You are putting in 3% of the money needed. I have a right to ask you for the papers. And that's how it is. I think the people should be bringing their docs to the buyer
yeah,
consult.
yeah, I had one that was just fortunate, right?
Yeah,
I had the
they were
lender with
proactive.
me, and yeah, the pre-approval was that day. We were ready to go.
That's how it
They did
works.
not buy a house, but
Yep. If well,
they were
that's
ready to go.
you can only check one box at a time.
But what was I gonna say? Oh yeah, because I started saying that because I would get buyers who they look at as they look at me, right? Or when they buy anything else in the world, that they should have this awesome customer service with the mortgage underwriter, processor, all this stuff, because you know you're making money off of them. But it's like, well, you got to think about it like you're borrowing money because you are borrowing money.
Yes. Yes.
And I think that helps the frustration, or at least they don't call me and complain because I told them about it.
You always tell them up front, bring your papers to the consult
Yeah, that would help things go a lot
tremendously.
faster. And I'll know how serious they are too. You really
You'll
want a
know
house,
how
you'll be right.
serious
You'll be
then
prepared.
you'll know what kind of time to devote to them.
Yeah. So last two questions are a little more inquisitive here. So you think with the current economy, current interest rates, there's a bigger chance that in the future that more and more buyers will need down payment assistance, which would make it easier for buyers to compete for homes when using these programs because you know everybody's got that program. Like, you know, certain
Well,
areas you got a lot of FHA, you're not competing for conventional.
the only thing I could throw at that, Patrice, would be MSHDA did change their rule that previous to maybe a year or so ago, if you were doing a MSHDA loan, you couldn't do a appraisal guarantee.
Yeah.
Now you can, but it can't be their money. Got to be your own money. But it used to be. So sometimes, and I've strategically worked with people like this. They had 20 grand, 25 grand, or whatever it is. Well, let's get you down payment assistance, and then you can use your money. And they're like, I want a house. I'm like, well, then let's use your money for an appraisal guarantee and Mishta's money for the down payment assistance. And it's 10 more that you didn't have. So there it is. That all changed 2 years ago when it became, or a year and a half ago when it became acceptable per their rules. And it made a lot of things work.
Yeah.
10,000 10,000 appraisal guarantee is not going to get you a house in Royal Oak, but it's going to get you one someplace.
Yeah, because that's the other thing too, is that it used to take Mr. a long time, depending on, I mean, it could still take a while longer, right? But
It can be when
it
there's
used to
heavy
be about
demand,
60 days sometimes, right?
right? We're closing most of them in 40 or less. If you got a good borrower who's sharp, sometimes 30.
Yeah.
Like we got one that's closing Friday. She wasn't here very long at all, but she was super smart. Boom, boom, boom.
Yeah, I call them organized, right? If I got to organize buyers.
This lady is sharp, very sharp. She didn't ask a lot of questions. You know why?
Because she
Because
was
she
smart.
read things and listened to what we told her. She didn't have any questions because she already got told them. Impressive
Yeah.
person.
So yeah, last big question here. Would you say that in some ways the down payment assistance is what's kind of helping us, not helping us, but it's kind of keeping us in this seller's market that we would otherwise expect to be a buyer's market because the rates are higher, values are higher, but we still have
Well,
more people buying homes than we have people selling their houses.
I feel like what's really keeping us in this seller's market is the fact that interest rates are 6 to 7%, and the homeowners have between 2 and 4%, and they're not going to let it go. That's why there's no houses. Does that?
Well, well, no, yeah, that answers, yeah, I'm not saying that, yeah, no, I think it's a lot of factors, right?
Yes.
That would be one of them, or you to move would cost you more money,
Well,
right?
yeah. Giving up a 3.5 to go to a 6.5. It doesn't work for most people.
Yeah. Or you don't have a mortgage right now. You've been there for 30 years, right?
Right.
Then
Right.
to buy another house to downsize is going to be a
But
lot.
you're right. Your point. The down payment assistance has put way more people into the market, so they're fighting with each other for houses. So that is keeping it a seller. That is contributing to keeping it a seller's market. I very much agree with that, because take these products away, and at least half the people who are out looking aren't looking. So that changes everything.
Because in reality, it would, I mean, now that you have 544, which you think would only be maximum 350 for a mistra, obviously, that doesn't include the people that are in the higher price points, because those are still getting
Right.
offers too, but you have all the other
Right.
factors that are also like, well, um, I'm still not putting my house for sale, and you still have people that want to buy.
Right.
Um, but okay, I think this was a really good discussion here.
Yeah.
Anything else that you want to add that you think would be beneficial in regards to down payment and down payment assistance?
Well, you don't know what you can or can't do until you call me, number one. And you can call me, and I'm going to say that I don't think there's a way to type it on the screen, but
Oh, it'll be in there later.
okay. Okay, but I'm going to say call Coach Billy Slobin, Slobin Mortgage Group in Farmington Hills, 248-535-0465. Call Patrice. She's a great agent. She's detailed, smart, honest, answers the phone, calls out on the phone. What else are you going to say? People
Oh,
don't
I mean,
talk on the phone, they hide.
what'd you say?
He talks on the phone. It's a good thing. Uh, get your paperwork in to us promptly and completely, and you'll be shocked at how soon you're out looking for houses.
Awesome. Yeah, that was going to be the last thing was asking how people could reach you, but you did that. Is there any other contacts you want to add to that?
My email is that's the only phone number I have. That's 248-535-0465. My email is very easy. Coach Billy at BillySlobin.com, and I'll spell it. Coach, COACH, Billy, BILLY, at BILLYSLOBIN.com. I'll email you back. I'll call you back. I'll text you back. You'll be shocked at how easy it is to reach me.
All right. Well, thank you so much for your time, and thank you everyone that stay tuned and are watching this later on. And I hope everyone has a great day.
Have a great day. And Patrice, thank you for making all this happen.
No
Great
problem.
job. Great
Thank
job.
you. You
Yeah.
too.
Thank you. Talk to you soon.
All right.
Okay. Bye bye.